Hello, fam. How you doing today? I got you good. So it's Timmy, your boy, Savvy Investor One. Okay. So how are you doing today? We are savvy. I hope you are still being savvy, right? Sure, you're being savvy. Good. So in today's meeting, one of the discussing risk management. How important is risk management? Our trade. I know you're gonna love that. You're gonna love that, right? So let's go on. Let's go. Let's go. Let's see what we're gonna do. Risk management. Yeah. So let me share my screen. Let me share my board. Let me share my whiteboard. Let's write. Let's discuss. So amazing, amazing, right? Amazing, amazing. So I want to discuss risk management. Risk management. So topic is risk management. Risk management. So what should be the color of the text? What should we make the color? Black, okay. Yeah, black should be okay. So we want to discuss risk management today. It's very important. It's very important because people have been losing money. It's not actually, commendable, right? Remember, we are savvy. We are supposed to be making money consistently. Our net result should always be positive. So, and one of the ways for us to have a net positive result that will be awesome for us is managing our risk. That's why we need to discuss this topic, risk management. So, what is risk management? I define risk management as the deliberate efforts. Risk management, I define this as the deliberate effort you make, I make, and every one of us will make as a deliberate effort. Sorry about this. Okay. I'm not actually good in the use of keyboard yet, so just get me. Deliberate efforts. Wow. Efforts we make. We make in an attempt to manage our risks in trading and investing. Wow, that's nice. So that's what I define risk management as. I define risk management as a deliberate efforts you make, I make in an attempt to manage our risk exposures in the markets. Okay, so that's what I define risk management as. Hope you're okay with this form. I hope you get the gist. I hope you get the gist. So feel free to drop your questions in the comment section. I'll do my best to attend to each and every one of your questions. Okay? I love you. And we need to make it all. We're gonna make it all. So that's what I define risk management as, the deliberate efforts we make. Sorry about this. Just saying it. Deliberate efforts we make. How do I put this? That's this. Text. Okay, sorry about this. So we define risk management as a deliberate effort to make an attempt to manage risk in in trading and investing. So now, what are the importances of managing risk in the market? The importances of managing your risk in the market, they are way numerous. One of which is that it gives you ability to have a stable psychology when you are investing or trading. Say, for instance, you are a medical doctor and then you bought some Bitcoin and the thing has been going down, you are in the operation room and you are losing your life saving in Bitcoin. It's not actually ideal. It can destabilize you and you start making some form of errors in your work, right? So you don't want to put yourself in that position where you will be so tense because you are actually investing in the market. Investing is supposed to be fun. Trading is supposed to be fun. It's supposed to be fun because you're making money and you can only make money net positively when you manage your risk exposure properly. So what are the types of risk? What are the types of risk we can see in the markets? Types of risk you can see the risk that where you over leverage your accounts. That is, you are putting more money than you're supposed to put. Maybe you have $100 account and you want to buy a token, you just carry the whole $100 and put it aside. It's not ideal, right? So you have overnight risk for those who trade futures and margin risk for those who trade futures. For those who invest, you have the risk of putting in all your money in one egg, in one basket rather. So let's see the various means by which you can manage your risk exposure in the market. That means by which you can manage your risk in the market. Some of them are we have the ways in which you can manage your risk, which ways like I told us, very good on keyboard. Just bear with me. The market, ways to manage risk in the market. I just want to make it, I don't just want to record the call and then just want to make it interactive. One of these days, I'm going to host a live session with us, okay? Like I've been doing before, ways to manage risk in the market. We're not yet on YouTube, but I've been doing that elsewhere. So ways to manage risk in the markets. There are many ways that we can manage our risk in the market. Some of them are number one. Okay, let's open up another any text box. Number one is dollar cost averaging. Dollar cost averaging. Dollar cost averaging. Dollar cost averaging. Averaging. Number two, we have the portfolio diversification. Excuse me. Portfolio diversification. Portfolio diversification. Number three, you have what else do we have? What we're going to talk about? We want to talk about portfolio diversification. We want to talk about, we could talk about dollar cost averaging, talk about use of stop loss, the stop loss order. Stop loss order. Next, we'll look at use of stop loss order. Next, we look at trading futures for those who can trade futures. Futures is actually a means of managing risk, trading futures on the Binance exchange. Futures on the Binance exchange, and then trading margin trading. Use of Launchpad. There are a lot of ways that we can actually manage our risk. Then taking part in Launchpad or initial coin offerings on the Binance margin and the Binance account, Binance platform. Why should you take it only on the Binance platform? Binance is already pre-vetted, like I wrote on my article, passive income. You need to read that article. I'm dropping the link on the description bottom. Okay, so ways to manage risk in the market, talk about dollar cost averaging, portfolio diversification, use of stop loss order, trading futures. So what is dollar cost averaging? Dollar cost averaging is a technique of investing in the market whereby traders split their capitals to be invested at different price intervals in the market. Maybe a 10% drawdown in the market value, 20% drawdown in the market value. People they keep buying. Say for instance, as Bitcoin has been going down, there's someone out there who has been buying Bitcoin consecutively, consistently for at every significant price down. Why? He bought the first Bitcoin at $30, $50 out of Bitcoin. Bitcoin dropped to $28. He bought again. Bitcoin dropped to 27. He bought again. Dropped to 25. He bought again. Just like that. Just like that. What is it doing? The net cost of buying Bitcoin will be an average of his total cost, which will be very, very way below $30,000. Right? That is what dollar cost averaging is. Portfolio diversification. Portfolio diversification just follows from the saying that you should not put your egg in one basket. So for instance, you don't want to hold one token above holding one token. You don't want to hold a token from one ecosystem or category of the cryptocurrency market, or even if when you are investing in stocks, you don't want to hold a stock or company that is in one category of the market, maybe utilities, maybe electricities and technology, the Nasdaq. You want to hold stock in the S&P 500 as utility. You want to hold stocks in Nasdaq, US 30, all those stuff. So those are diversification, because stocks in Nasdaq may be doing well, while the stocks in S&P 500 are not doing well, right? Stocks in S&P 500 may be doing well, while those in the US 30 index, those utility are not doing well, right? So those are the things you talk about diversification. So also in the cryptocurrency market, the metaverse category may be doing well, pumping, while the ecosystem launch, ICOs and the rest of them will not be doing well. Proof of stake, they won't be doing well. While there's some of them that are in the DeFi ecosystem will be doing well, while the metaverse will not be doing well. So you don't want to put your egg in one basket. You want to be adequately diversified across the various token and exchanges. So that is what portfolio diversification is. So stop loss, use of stop loss order. I talked about this in the last video I created, right? We want to talk about the use of stop loss. What does stop loss order does for us? Now, if you are in long or you bought assets in a bullish market and you want to set take profit and stop loss, that is where the market should take you out, where your finance or your exchange should take you out. Okay, that's what you want to do, so that you don't incur heavy loss. Say for instance, after doing your risk management, you calculate, you say that okay, this investment, I want to risk $50 on this investment, and then you put in $200 and you set your stop loss at a $50 loss, right? So once the market goes below that particular point in price, you'll be taken out, and then if say for instance you bought Bitcoin at $40,000, Bitcoin goes to $60,000. You don't want to say you want to hold it, but then you set your stop loss at $50,000, right? So it means that when Bitcoin fell below $50,000, your stop loss order got triggered, and then you're out of the market and you are in profit. Although your profit may not be very big like you want, but then you're in profits, and you see what Bitcoin has actually done, right? Bitcoin has fallen from $60,000 all the way to $27,000 currently. As I'm making this video, so that you've actually been able to mitigate that risk, right? So that's one of the things that ways you manage risk in the market. Now, trading futures, by trading futures, you are not actually putting your money in one basket, just like portfolio diversification. You're having your money in stablecoin. You're not having your money in assets. You know, when you have assets, unlike stablecoins, you experience that psychological trauma associated with owning a depreciating asset. You experience that fluctuation and volatility in price, right? You don't want to expose yourself to that. You want to do everything possible that you are okay, you are diversified, you're adequately diversified. But then remember, just trading is risky. It's way risky. Though the upside is still high, but then it requires a whole lot of know-how to take part in futures trading. So that is that. So now, what are the importances of risk management? Numerous are the importance of risk management. One of which it helps you. Importances of risk management. Importances of risk management. Right? Yeah. The numerous are the importances of risk management. I would say one of them is it helps us overcome the psychological trauma associated with depreciating asset, associated with losing money in the market. Now, it helps us as overcoming the psychological trauma of losing money. Logical trauma of losing money in the markets. In the market. That is number one. Number two, it helps us to prevent losses to our capital. It helps us, okay, it helps us to capital preservation. Let's say capital preservation. Remember what Warren Buffett said? Warren Buffett said that capital preservation is paramount. He said, never forget rule number one. Rule number one, preserve your capital. Rule number two, never forget rule number one. So capital preservation is very, very paramount. So it helps us preserve our capital, right? So number three, it helps us stay in the game long. Yes, yes, by preserving our capital, we are able to stay in the game. It gives us the opportunity. It helps us to stay in the market long. It helps us to stay in the market long. What other importances? Think about them. Yeah, think about them and fill the boxes. Now, overcoming the psychological trauma of losing money in the market. Have you actually lost money? Maybe you bought a token because you did not set stop loss. The markets went to so deep, and then you sold it. And immediately after you sold it, it pumped. How did you feel? I believe you felt, oh God, what's this? Yeah, and you felt so bad because initially while the asset was going down, you were feeling down, you felt a whole lot of things. You see, so that's actually one of the reasons why you need to manage your risk. And in that category, in that scenario, you should have used a stop loss order, right? To manage that risk. Now, capital preservation, because you sold at a loss, you already lost your capital, right? Yeah, you lost part of your capital, if not all. Okay, you lost almost a lot of part of your capital because it's not advisable to even lose $1 from your capital, but then it's still possible. So instead of losing way much, you just do as much as possible to mitigate or cut your risk, right? It's possible. A little loss is better than a big loss. And the next is helps us to stay in the market long because you are doing adequate risk management. You are preserving your capital aggressively. You will still have the opportunity to stay in the market. Imagine now that you're trading futures and you've been making losses and you don't use stop loss orders in futures trading. You just keep on blowing your account and you keep on funding. Trading is actually a business. Investing is business. That's what people do. Hedge fund managers, investors, and then investment banks. That's what they do. Yes. So, but one of the things they do to keep up and to stay in the game is risk management. So if you don't manage your risk adequately, you keep on funding an account and you never withdraw. You understand? And that is not what you want to do for any business. You cannot just be financing your business. You need to be making profit from your business. And if trading and investing is a business to you, you definitely need to do everything possible to make money from trading. So that's basically what we'll have for today's meeting on risk management. If you've got any question for me, feel free to drop them in the comment section. I'm going to attend to each and every one of them. Thank you, fam. I love you guys. Remember, we are savvy. We are always winning. Thank you so much and do have a wonderful day.